Welcome to Alpha Recap, your aftermarket rundown from stockalpha.ai. I'm glad you joined us. As always, if you have questions, you can reach us at stockalpha.ai. Today, we're unpacking a busy set of briefs. Surging search interest in CPI, heading into a key inflation release, wild microcap moves over the long weekend, and a courtroom win for Exxon. Let's dig in.
Great to be here. That CPI search jump and the microcap fireworks made for a noisy close to the week.
First up, the macro story. Over the weekend, Google Trends showed about 20,000 searches for CPI and about 10,000 for CPI report. That's a pretty big spike in attention. What does that typically mean for markets?
When both retail and institutional attention surges like that, it usually raises the odds of bigger moves once the data prints. Investors are more keyed in, liquidity providers can pull back, and bond yields and rate-sensitive parts of the market tend to move more violently. So think long-duration Treasury products and S&P 500 exposure. They become more vulnerable to intraday whipsaws.
So to be clear, by long-duration Treasury products, you mean the ETF that tracks long-term Treasuries, right?
Exactly, the long-term Treasury ETF. When CPI surprises, that ETF and similar instruments usually saw outsized moves, and the 2-year and 10-year yields are where you want to watch immediate repricing. A surprise can move those yields meaningfully and spill into equities, especially growth, real estate investment trusts, and utilities.
Good reminder to think headline versus core CPI too. Headline includes energy and food, core strips those out. Traders react differently depending on which one surprises.
Right. Headline tells you about immediate inflation pressure and energy shocks, while core is often a better read on underlying demand. Both matter, but they drive different market moves. If headline comes in hot because of energy, energy stocks might rally even as bond yields jump. If core is hot, that's a clearer signal of broader price pressure and typically hurts rate-sensitive areas.
Okay, let's move to the microcap story. Over the holiday weekend, several small names made extreme moves. One jumped about 322% to roughly $44.50, with about 90,000 shares changing hands. Another was up about 112% to about $12.34, with roughly 1.3 million shares traded. A third climbed about 75% to about 82 cents, but with enormous volume, about 337 million shares. At the same time, one name plunged about 63% to around 23 cents and traded about 146 million shares. Those are wild moves. Walk us through what likely happened.
Those are classic thin book, momentum-driven episodes, often amplified by the timing. Several of these swings happened as markets were closed for the long weekend, or on the last trading day before the holiday. With fewer market makers and lower overall liquidity, even modest order flow can create huge price moves. You also get a mix. Some moves came with massive volume, suggesting real participation, and some printed on token liquidity where a single buyer or algorithm can spike the price.
When you say token liquidity, give an example.
There were names that moved higher while trading just 176 shares, or another that traded roughly 9,800 shares. When you see that, spreads blow out and execution risk is enormous. If someone tries to buy size at those prices, they'll likely pay a big premium. And anyone trying to sell after the spike may find almost no one to take the other side.
So for traders and portfolio managers, how should they treat these moves ahead of markets reopening Tuesday, February 17th?
Traders should size down, prefer names with clear volume backing, and use stop limits or limit orders to manage slippage. Risk managers need to think about margin and forced liquidation risk. A big overnight move in a microcap can cascade into margin calls if positions are concentrated. Long-term investors should avoid making allocation decisions based solely on these headline moves and wait for confirming filings or substantive corporate news.
Volume really is the confirmatory signal. If a pop comes with heavy volume, it can validate momentum. If it doesn't, it's usually fragile and could reverse quickly.
Exactly. Treat high-volume breakouts differently than low-volume spikes. The former can lead to follow-through. The latter often means you're looking at a short-term squeeze or a one-off trade.
Let's turn to the legal headline. A judge ruled Exxon could sue the California Attorney General for defamation related to recycling comments. That's a notable legal opening for a major energy name. What does that ruling imply for corporate regulatory dynamics?
It's important because it gives Exxon a legal avenue to seek reputational remedies, even though there were no monetary damages reported in this decision. More broadly, it signals that corporations may push back against aggressive public statements from officials, which can change the tenor of regulatory relations. It also reminds investors that legal and reputational risk can affect sector sentiment, especially in energy, where policy and public perception matter a lot.
Should investors expect that to cool off rhetoric from state officials, or will this likely just be the start of appeals and more noise?
Probably more noise. Expect appeals, filings, and public statements from both sides. Any new monetary claims, settlements, or disclosures about financial exposure would be the real market-moving items. For now, it's mostly reputational, but it changes the playbook a bit. Companies might litigate more, and regulators might calibrate their public messaging.
Switching gears, Alpha Pro Tech filed a Form 13G. That's a passive ownership disclosure. Why does that matter?
A Form 13G usually indicates a passive holder has crossed a reporting threshold. That can matter for float and liquidity. If the filer later becomes active or amends to a Form 13D, that's when things get disruptive. So holders of Alpha Pro Tech should read the 13G to see who the filer is and how many shares they reported.
Quick hits before we wrap. What should listeners keep on their short checklist when markets reopen Tuesday?
First, the timing of the CPI release and the headline versus core split. That will set the tone. Second, watch the long-term Treasury ETF and the S&P 500 ETF for heavy intraday swings. Third, check whether those high volatility microcaps held their gains with follow-through volume or reversed. Fourth, scan for SEC filings, 8Ks, or press releases from the microcaps. Look for dilution or material news. Fifth, monitor Exxon for any appeal filings or commentary from the Attorney General's office. And finally, read the full Form 13G for Alpha Pro Tech and watch for amendments.
Those are solid, actionable points. Any quick risk management rules you'd remind listeners of?
Yes, size conservatively into potentially volatile names, prefer limit orders to market orders in thin names, and keep stop sizes realistic given potential intraday volatility after major macro prints. If you're risk-averse, hedge or trim rate sensitivity ahead of the CPI release.
All right, let's close with 3 clear takeaways from today's briefs.
1. The spike in CPI search interest foreshadowed a higher probability of volatile moves when the report landed. Watch Treasury yields and rate-sensitive sectors. 2. Microcap fireworks were driven by thin holiday liquidity and a mix of real volume and token trades. Treat low-volume pop-ups as fragile. 3. The Exxon ruling underscores that legal and reputational headlines can matter for large-cap sentiment. Follow-up filings could move peers.
Perfect. Thanks for breaking that down. If you want to dive deeper into any of the names or strategies we discussed, remember you can ask us directly at stockalpha.ai.
And we'll be watching the CPI release and the reopening action on Tuesday. Expect volatility and watch your sizing.
That's a wrap for today's Alpha Recap. If you have questions about anything we covered, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you after the next close.